In this video, as part of the Candlestick School series, we're talking about the Bearish Engulfing Candlestick Pattern. Stay tuned. Hey traders, a very warm welcome to you. Welcome back if you're a subscriber. If you're new here, also a very warm welcome to you. Okay, so Bearish Engulfing Candlestick Patterns. This is a very, very powerful pattern. We've talked about this before, but I want to really drill down into the pattern, the best conditions for it, and show you some examples on charts so we can see where our stops are going to be, how far this thing runs, what our risk reward ratio is, and kind of get a real flavor in the real world as to when we'd take it, when we wouldn't take it, all that kind of stuff. Okay, so let's go. Bearish engulfing, let's have a quick recap on what exactly it is. So the prior day, this is day one, and this is a green candlestick, right? This is like a green candlestick. We're a daily chart here, opened at the low, closed at the high, green body, few wicks and tails, whatever. Normal candlestick on the chart. Right, next day, we get a gap up. So the gaps up, and I prefer to see a gap above the prior day's high. Some people say it just has to be above the prior day's close, but for me, I like to go full extreme on it. So we see a gap up above there. Maybe we do a little bit of work to the upside, but ultimately, the point is, during that day, we undo that gap up. Not only do we undo the gap up, we take out the prior day's close, we take out the prior day's open, and we take out the prior day's low. So it's a full change in sentiment. Bears have rejected the gap up. Bulls are so happy. We've got a green candle. They've gapped up above the high. It's all bullish. It's ticking the boxes. Maybe we do a little bit of work to the upside, push up a little bit in the morning, whatever it may be. But for whatever reason, that sentiment shift changes. And these candlestick patterns, guys, are all part of this Candlestick School series, really are looking for shifts in sentiment. And ultimately, isn't that all we're looking for as traders? We're looking for that shift in sentiment. If we can get on the end of that, we're on to winners. Right, so the sentiment shifts to bearish. We get a lot of supply coming into the market, whatever market we're looking at. We'll talk about markets in a short second, but we drive lower, we close. I like to see a close below that low. Some people just like to say a close below the open. No, I really want to see that thing engulfing. That's why it's called engulfing. The body of the candle is engulfing the prior days. Okay, there's our quick recap. Right, it's best on stocks and things that are gapping because we have that gap. Now, some people, like I say, are a bit more flexible, and we use it on currencies and say, well, as long as we kind of open, at high, and we do that, then that's still feasible and fine. If that's your thing, then of course any of these things can be melded, adjusted, and tweaked to suit your strategy, your style, your market conditions. For me, I like to use it in things that are going to gap. So you're only going to get that obviously once a week on currencies when on a Sunday night. But stocks, you're going to get it potentially every day. You've got a massive universe of stocks, massive universe of shares. Any country, whatever country you're watching this from, it's going to work. If you have that gap that gets rejected and you get that shape, you want to be paying attention. Okay, so daily chart, obviously because of the gaps, that's when it works best. This is one for those who are swing trading. It's one for those who are looking for those multi-day moves, multi-week moves, or even kind of investors who are looking to fine-tune that entry, use a bit of technicals, use a few kind of trading, short-term trader tricks to get on something that potentially you want to invest in. So if you're an investor, you've already said, okay, I like the balance sheet, whatever your criteria is for investing. And then when you see a pattern, you're pulling a trigger. In this case, of course, being bearish, you're either going to be shorting or you're going to be closing out your long position. All right, so let's look at one. I've got one for you here. I've got a loser as well. So for fairness, we can see how we would trade the thing. So here's one here, guys. We're on Twitter. We have, just look at the raw candlestick pattern first, then let's look at the prior conditions, then put them two together and see how we get on. So the raw candlestick pattern is this. The prior day was, okay, that is almost a doji, but in technical terms, we've got a green body and we have gapped up. There's our open on our red candlestick, and we have closed below the low, just about on this one. The prior day's low is 44.87. The close on here was 44.82. So just about, but it still qualifies. In other words, it engulfs the whole of the prior day's range. The body engulfs the whole of the prior day's range. Your trade for this is two ways. First of all, you take it on the close. So in other words, the close here, what was it, 44.82? You're going short or you're exiting long, of course, depending on how you're looking at it. But let's say we're going short here. We're going to be extra aggressive, going short at 44.82. Our stop is going to be above the high. So the high in this candle here was 46.79. I'm just looking at the top here, by the way, when I hover the cursor over, 46.79. So I'm probably going to go 10 cents, 15 cents above that. And I'm going to have my stop around that level there. So there's going to be my stop, there's going to be my entry, and we're going to run this for as long as we think we're going to get a good move. Now, okay, we've got a couple of options here. We can either run it as part of a longer term thesis and say, you know what, we think Twitter is a dog, we think it's going to go down to $10, this is my good entry point, I'm going to trade it, fine, by all means trail it, cut some off, scale it. Don't have to go into full details here. We can take a couple of day move depending on the conditions we're in. Look at those in a second. Or, you know, we can kind of have a specific target, maybe the prior low here. The important thing is, guys, standard kind of procedure here, risk reward ratio has got to be top. This is a good pattern. This has got a high probability of success. If you combine it with a decent risk reward ratio, you're on to a winning strategy. Okay, and the other option is, of course, you take it on a break of the low. So if you've got something like this where it's not particularly a solid candle, and by the way, I prefer a solid candle, but if you don't get it, that's fine. I wouldn't want to see this too low, if I'm honest. Let's just kind of discuss that a second. I wouldn't want to see a wick that goes too far there. That would put me off a little bit, because that becomes more like a hammer as opposed to let me see if I can remove that, as opposed to a bearish engulfing. So a nice big body, but that's okay, it's acceptable, and it's taking out the prior day's whole range, which is what we want really. So we can either take it on the day after when we break that low, and again, stop, you're going to be above that high. If you want to play around with it and kind of have it 50-50 or 2/3 of the range, I think that's fine, depending on the conditions you're in. While we're talking about conditions, let's look at that, because this is so important. And this is where I think a lot of people go wrong, is they use it under the wrong conditions. You know, they see the bearish engulfing and they think, yeah, it's a bearish engulfing, I'm all aboard it, but it's just the wrong overall conditions for it. You know, if you're a subscriber, you know, appreciate your subscription, by the way. You'll notice that I talk about taking a powerful pattern and plugging it into the right conditions. That's where the sweet spot is. A powerful pattern is almost useless when you put it in the wrong conditions. It's about using the right tool for the right job. You know, I've learned this the hard way, guys. You know, I've learned this the hard way. But it's way more successful when you use it in the right conditions. You're going to get less signals, of course, but you're going to get more powerful signals. So what I mean by that, so bearish engulfing, hey, it's a short trade or closing a long trade. Let's just stick to the short thesis for now. Short trade under bearish conditions, a trigger to go in. So what I don't want to be taking it in an uptrend. Well, some people might say, hey, if I see that bearish engulfing candle at the end of an uptrend, you know, we're going to reverse. That may well be the case, but in my experience, what happens is you may get a little retracement, but overall, the overall underlying sentiment often rings true. And 1 out of 20 times you'll get a full reversal, right? Fine, if you want to take that and that's your game, but you've got to have as part of your plan, hey, you know what, my risk reward ratio is like 50-1 on a multi-month, multi-quarter move to make up for the fact that this works very infrequently. Okay, compare that in an uptrend to a downtrend, a pullback, then taking the bearish engulfing. You've already got the wind behind you. You've got the weight, the pressure on the market. It pulls back. You get that trigger pattern, which is your bearish engulfing. Everything else is lining up for you. And this is kind of the pattern we've got with Twitter. We've got, you know, multi-month down move from the highs. Whatever the highs was here, $70, $72, pushed down to 44. You know, no one can argue that's not bearish. Okay, so we have that bearish undertone with it. We have a pullback. You know, the bulls have had a good effort here. They've kind of pulled back off the lows, stagnated a little bit, and then we get the pattern. Is it always going to work? Of course it's not. That's why we have our stop criteria in. But we have the right pattern bolted into the right conditions. Bearish market, bearish conditions, lots of supply, not as much demand, short-term demand coming in, sure, but it's not really encroaching on that bigger move. Then we get the bearish engulfing, and then look at that. You know, if we're holding it, you know, I hate to be the kind of person who says, oh look, you could have got out at $30 here. You know, no one's going to be doing that, unlikelihood. But the point is, look, you've got multi-day moves, gap lower, maybe you took out on the gap lower, maybe you trailed it, or like I say, if you're looking for a longer term play, maybe you kind of held it and then got stopped out on a trail on your last quarter. Whatever, it doesn't matter so much. The point is, it's putting in the right conditions. And here's a loser for you. just to show you why I think it's so important that you have it in the right conditions. This on its own, this candlestick pattern on its own is beautiful. This is the beautiful bearish engulfing candlestick pattern. It is textbook. Look at the size of that thing. Big gap up, some work to the upside, rejected, and then closing below the low of prior 3 days. It is just beautiful. You just look at that and go, that's a dream. But then, like I say, plug it into the right conditions. This happens to be a loser. If you took it there, if you took it on the break of the low, it's all very similar close and low, isn't it? You're going to get stopped out. You're going to have lost some money on that trade. Why? Now, I don't like to kind of say, oh, the hindsight says I would never have taken it. But the point of plugging it into the right conditions is this. This isn't the right conditions, guys. A rally from 115 to 140 and then seeing bearish engulfing isn't the right conditions. The success rate of that is going to be low. Is it going to work from time to time? Yes, it's going to work from time to time. You're going to get a retracement. You might even get a reversal of the trend. But the key thing here is you often get this, a little flurry to the downside, maybe 1 or 2 days, and then it undoes it because you're in the wrong conditions. The overall sentiment on this thing is bullish, and you're trying to plug a very short-term bearish trigger, i.e. 1 day, into how many days that is, 2 or 3 months worth of uptrend, aggressive uptrend. You can see the difference between that and Twitter, right? 2 distinct different things. One's in a downtrend, Facebook's in an uptrend. So you're plugging the same pattern but into different conditions and getting different results. So just to recap, guys, we've got bearish engulfing, very powerful in the right conditions. I'm repeating myself, but honestly, because I've learned this by wasting money on plug patterns in that are the right conditions. So you want to be in bearish conditions or rotational. Finding rotational, maybe a top of rotational move, range type environment, that's cool. What you don't want is the real distinct supply demand imbalance in the favor of the bulls. You want to see that gap up, failed, engulf the prior day's trade, take it on the low, trail it, run it, have a 2 or 3 day move if you're scalping in a range conditions, whatever it may be. The point is, it's a powerful candlestick pattern used wisely. Okay guys, hope you enjoyed the video. Give me a thumbs up if you did. I'll see you in the next one. Take care. Good trading. Bye bye.